Welcome to this presentation on managing cash and credit. In this presentation, we'll explore the fundamentals of managing your money wisely, from understanding liquid assets to choosing the right financial institution. In this chapter, you'll learn how to manage your cash and liquid assets effectively. Our key objectives include understanding the importance of cash management and why we need liquid assets, comparing cash management options, and identifying the various financial institutions that help manage your money. By the end of this presentation, you will be able to compare different options for managing your cash, recognize the impact of inflation on your savings, learn the importance of automating your savings, and know how to evaluate financial institutions and cash management options to meet your needs. Let's start with a fundamental principle. Having savings provides financial stability. Experts recommend keeping enough liquid savings to cover 3 to 6 months of living expenses. This emergency fund acts as a safety net, helping you de-risk your overall financial picture and weather unexpected events without derailing your long-term plans. Most financial experts agree that having savings set aside is one of the most important steps you can take toward financial security. But simply having money isn't enough. You need to understand how to manage it effectively, balancing accessibility with growth potential. A liquid asset is anything of value that can be quickly and easily converted into cash without significant loss. Examples include checking and savings accounts, money market accounts, and certificates of deposit. These assets form the foundation of your personal financial safety net. Why do we need liquid assets? There are 3 key reasons. First, they serve as an emergency fund to cover unexpected expenses. Second, they provide the flexibility to manage your day-to-day finances. And third, they allow you to take advantage of financial opportunities as they arise, without having to sell long-term investments at a loss. So what exactly is cash management? It's the process of managing your cash and liquid assets to meet your financial needs. This involves making smart decisions about how to allocate your funds among checking accounts, savings accounts, money market accounts, and other short-term instruments. The goal is to keep enough cash accessible while maximizing the return on your idle funds. Cash management is the process of planning how you handle your money on a day-to-day basis. It involves tracking your income and expenses, maintaining an emergency fund, and ensuring you have enough cash available to cover your regular obligations while still working toward your long-term financial goals. Now let's dive deeper into understanding liquidity. Liquidity refers to how quickly and easily an asset can be turned into cash. Cash itself is the most liquid asset. Savings accounts are highly liquid, while real estate or retirement accounts are considered less liquid. For example, money in a savings account is highly liquid because you can withdraw it at any time. A certificate of deposit is somewhat less liquid because withdrawing early may result in a penalty, but it can still be converted to cash relatively quickly. The key is finding the right balance between liquidity and earning potential in your financial plan. However, there are drawbacks to holding too much cash. While cash is safe and accessible, it comes with a significant trade-off. Cash earns very little return, and over time, inflation erodes its purchasing power. In other words, the money sitting in your wallet or a low-interest account is actually losing value every year. To illustrate this point, let's look at U.S. inflation rates over the past decade. From 2016 through 2020, inflation remained relatively low, hovering around 2%. But in 2021 and 2022, inflation surged dramatically, peaking at levels not seen in decades. Although rates have since declined, this serves as a powerful reminder of why simply holding cash can be costly over time. One of the most effective strategies for building your liquid savings is to automate the process. Pay yourself first by setting up automatic transfers from your paycheck to your savings account before you have a chance to spend it. This approach works because it removes the temptation to spend first and save what's left. By making saving automatic, you ensure consistent progress toward your financial goals without relying on willpower alone. Now let's examine the financial institutions where you can keep your liquid assets. Deposit-type financial institutions commonly known as banks, are the most traditional option. These include commercial banks, savings and loan associations, savings banks, and credit unions. Each serves a slightly different purpose, but all accept deposits and are typically insured by the federal government. Commercial banks are the most common type of financial institution. They offer a full range of services, including checking and savings accounts, loans, and investment products. Savings and loan associations, also known as thrifts, originally focused on accepting savings deposits and making mortgage loans. Today, they offer many of the same services as commercial banks. Savings banks operate similarly to savings and loan associations and are found primarily in the northeastern United States. They are mutually owned by their depositors. Credit unions are nonprofit cooperative financial institutions owned by their members. Because they don't need to generate profits for shareholders, credit unions often offer better interest rates on savings and lower fees than traditional banks. Beyond traditional banks, there are non-deposit type financial institutions that offer similar services. These include mutual fund companies, brokerage firms, and insurance companies. Mutual fund companies pool money from many investors to purchase securities. Some offer money market mutual funds that function much like savings accounts. Stock brokerage firms, which primarily help clients buy and sell securities, now offer cash management accounts that provide check writing, debit cards, and other banking-like features. These institutions have expanded their offerings to compete directly with banks for your liquid assets, often providing checking-like accounts and debit card access. When choosing a financial institution, ask yourself 3 important questions. First, what services do they offer, and do those services match your needs? Second, how safe is the institution, and are your deposits insured? And third, what are the costs and fees associated with their accounts? Comparing these factors will help you find the best fit for your financial situation. Now let's explore the various cash management techniques available to you. Checking accounts are the most basic tool, offering easy access to your money with check writing privileges. Regular savings accounts provide a safe place to earn modest interest. Money market deposit accounts typically offer higher interest rates than regular savings, while still providing limited check writing ability. Additional alternatives include money market mutual funds, which invest in short-term securities and often provide competitive returns. Certificates of deposit lock your money away for a fixed term in exchange for higher interest rates. And asset management accounts offered by brokerage firms combine investment and banking features into a single comprehensive account. Other cash management options include United States Series EE savings bonds, which are a safe government-backed investment. Series 1 savings bonds offer inflation-adjusted returns, helping protect your purchasing power. And United States Treasury bills are short-term government securities that can be an excellent place to park larger sums of cash for brief periods. Understanding the difference between APR and APY is essential for making informed financial decisions. When comparing interest rates across different institutions and products, it's essential to understand 2 key terms. The annual percentage rate, or APR, is the simple interest rate without compounding. The annual percentage yield, or APY, takes compounding into account, showing you the actual return you'll earn over a year. The more frequently interest compounds, the greater the difference between APR and APY, and the more your money grows. APY gives you a more accurate picture of what you'll actually earn, making it the better metric for comparing savings products. Always compare APY to APY when evaluating your options. Let's review the key takeaways from today's presentation. Managing cash effectively requires balancing risk and return. You should aim to save a portion of your income automatically through the pay-yourself-first approach. Liquid assets provide accessibility, but may offer lower returns. Inflation reduces the purchasing power of idle cash over time. Finally, remember that various cash management alternatives are available, each with different rates and returns. Choosing the right financial institution involves evaluating their services, safety, and fees to find the best match for your needs. Safety of your deposits should always be a priority, which is why government insurance programs matter. And electronic funds transfers have made managing your money more convenient than ever. You can use the APY to measure the returns on different cash management options and better compare them. Managing your liquidity is a foundational step to secure financial planning and allows you to build off of these strategies to include riskier assets and higher returns on your investments once your liquidity needs have been met and supported with the products and strategies presented.